Picking great stocks is much simpler than you think. And that's why my chief financial analyst said to me, Felix, why don't you package your banker knowledge into 5 or 6 simple criteria that beginners can follow to find great stocks and create tremendous wealth. This here is my chief financial analyst, so therefore this is not financial advice. This is feline advice. So let's get cracking. I'm going to share my screen with you so you can see criteria number 1. And if at any time you think this is too complicated, jump to the section that says simple, but really you're going to miss out on like 80% of the benefit of this video and the glorious free things you're going to get your hands on here. So gross margin, I know, sexy, isn't it? What does it mean? Well, if you think about a company that is selling a product minus the cost of selling it. So it's basically the money they get minus the basic cost of selling that. That is the gross margin. Now, a good company, a good business has a gross margin that is greater than 60%. And that says to you there is no pesky competitor snapping at their heels, charging less than they are. And it means the product is special, fantastic, hard to replicate. In short, it's a pretty good business. Otherwise, you wouldn't be able to charge a premium for it. For me, this is the first thing I look for, greater than 60%. Now, slight caveat, if you invest in manufacturing businesses, you're not going to see 60% margins typically because they have to pay for all the machines and the factory and the staff and the robots and the canteen lady and all of that stuff. So service businesses generally are in a much better position for this, which is why I prefer service businesses. Now, what's criteria number 2? Well, before you get to that, you're going to say, Felix, where do I find the data? Where do I find the gross margin? Well, here it is. I give it to you for free. Go to felixfriends.org/SP500, SP500, and you will get your hands on this glorious spreadsheet that I put out about 2 or 3 times a year. And you see the gross profit margins of every S&P 500 company out there. So say Apple, 44%. Sort of a manufacturer, you see. But if you scroll down, you'll find a lot of good companies, and you can just click on file, make a copy, then it's your own. You can filter and sort by these and mess around with this generally. Highly recommend you get your hands on that. I've also put a summary of our lessons in here in the second tab, so you have that as well to study and chew on. So what's item number 2? It gets sexier and sexier. It is return on invested capital. What the heck does that mean? Basically, how much are they making from the dosh that shareholders and banks and lenders give them? Are they good at turning money into more money? Typically, I want this to be greater than 10, maybe 12%. The bigger, the better, of course. And why do I say 10 to 12%? Because those are the kind of returns I want from my stocks on a sort of base level. So if they are not making that return, then what the heck, right? What are they doing? What are we wasting our time for? And you'd be surprised. There are a lot of companies out there that have a 4% return on invested capital. You might as well shut the thing down and stuff it in a savings account, right? You pretty much get the same thing, at least with a decent bank. Well, maybe not a decent bank, but you know what I mean. Is there such a thing as a decent bank? That's a whole topic for another question. A whole nother question for another topic. Now, free cash flow. Okay, now we're getting serious. Do you know someone who runs an Amazon business? You know, they buy stuff somewhere, they sell it on Amazon for a small margin. Every time they make a sale, what happens? Well, they receive some cash, and then they take that cash, and what do? They buy more stock, more inventory, and then they sell that, and they get more cash. And what do they then do with the cash? Well, they buy more stock, and this thing kind of goes around and around in circles. So while they're making a profit, they never actually get to put their hands on the money because they always needed to buy more inventory. They need to invest it. Same is true for large companies. They have to buy another factory, another machine, another private jet for the C-suite to fly around in, or God knows what. And those businesses suck. So you want a business that has a free cash flow margin that is, well, no hard rules, but 20% and higher is typically what great businesses do. So that's item number 3, actually generate cash. And why is it important? Well, it means they don't have to borrow money. They'll survive if the market freezes and no one's going to lend them any money because interest rates are crazily high, or just generally they're not going to dilute you as a shareholder by printing lots of shares to bring capital in, because it's the only way they can pay for the next plant or the next machine or the next outing of the C-suite to an island somewhere near you. Number 4, this is the stuff about survival. Interest cover. What does it mean? Well, let me show you an example in here. So if we zoom in a little bit on this column here, interest cover ratio. Out of their profits, how easily can they pay for the interest on their debt? Most companies have some debt. That's fine. It's a good way to grow. You grow faster and so on. But if your interest cover number is really, really small, or negative because you're not making any money, well, there is a good chance you might go out of business. So it basically is your great big warning signal, as in, is this business at risk of going out of business? So the higher the better, but definitely you want this to be probably 3x or 300 or 400%, something like that, so that no matter what happens, even if interest rates double or triple, they'll still be able to pay for it and they'll survive another day. Now, PE ratios. Everybody talks about PE ratios. Well, forget about the blasted things. And you know why they are useless? Let me give you an example. If you had bought Netflix in 2015, the PE ratio at the time was 554 times X. And everybody would have said to you, you're an idiot. You're paying far too much for that stock. How could that be a reasonable price? Well, what would have happened is that you would have held on to those shares from then till now. Earnings, which is a fancy word for profits, have since gone up 100 times. So the 9 cents of earnings per share have gone up to $9 or actually even $10 now. So it's even a little bit more than that. So your PE ratio will have gone from 554 to only about 5x. What does that mean? That means your stock, the company, makes in 5 years the exact value of your share. And that's a 20% return. Think about that as 1 over 5 is 20%. Now, a 20% return is pretty staggeringly exciting, right? Try buying a property, try getting your tenant to pay you 20% of what you paid for the property a year. It's not going to happen unless you are a slumlord somewhere really nasty. If you are, tell me where. So, PE ratios are a snapshot. They don't matter. What actually matters is, do profits go up? Is it a good business? Do the numbers we looked at above stack up? Now, there is one more item I'd throw into the mix, and that is the good old moat. Now, the question is, are there alligators in the moat? Is the moat deep and vicious? Is there a huge wall on the other side of the moat? And what does that mean? It means it's hard for competitors to come in and replicate the product or the business or the service. And if you look at something like an Apple, is it hard to make another one of these, a phone? Well, reasonably hard, but not that hard. I could probably go to some manufacturer in China and get myself an OEM, a white labeled phone. But what is incredibly hard is to put up all the stores, build the brand, build the ecosystem, the app store, the stuff that connects to all your Apple devices, and build this sort of evangelical following that makes people sleep in the street the night before a new product is released by your brand. So that's a moat. There are other types of moats, like a patent, like some technology that's exceptionally rare, say Elon's rockets. That's hard to copy because you need billions of dollars and you need rocket scientists. What's easy to copy? Well, I just walked down the street. There was a frozen yogurt shop. Around the corner was another frozen yogurt shop, and around the next corner was another frozen yogurt shop. That's a business with no moat. They're all offering the same thing at basically the same price, so they're going to compete themselves to death. That's a terrible business, right? So chargers, for example, EV chargers, I've always said, sell electricity. That's the purest of commodities. Therefore, I don't see what the business model is. It's got no bloody moat. So look for things that are hard to copy. Now, if you don't know that, look at the gross profit margin, because if your gross profit margin is really, really high, well, Autodesk 91%, I'm not sure what they do, to be honest with you, but it clearly is fairly hard to replicate. Otherwise, they wouldn't be able to charge 91% gross profit margins for that. And the same is generally true for all good businesses. They have very, very high margins. So what's next then? Well, the next thing to understand is how to actually invest. Now, the 99% invest very differently from the top 1% who are sitting on the Upper East Side throwing rocks at the poor people, because the 99% invest what is left at the end of the month, which tends to be very, very close to $0. So they go out, they spend, they pay for their mortgage or their rent and their car insurance and all their other obligations, and enjoy themselves and go on holiday and pay for their children and their Labradors and that sort of thing. And then whatever is left at the end of the month, they go and invest it. What do the 1% do? Well, they invest first, and they then spend what is left. And that just means you've prioritized wealth building, and you're therefore going to be wealthy, versus you've prioritized living nicely, which means you're going to struggle for quite a long time. I didn't know we could move half the text around. So make a plan. Write down, do this with your partner or your spouse, and say, we are going to save and invest X% of our income before we spend anything else. And therefore, there is no temptation to go and blow it on some, something. Black Friday today as I'm recording this. So don't blow it on something. Now, if all of that was a little bit too complicated for you, I get it. Look, not everybody wants to pick stocks. Totally get it. Well, there are simpler ways of doing this. What I would do is I would buy essentially an ETF, which is an exchange traded fund, which tracks an index. Now, most people will say to you, buy SPY, which is the S&P 500. I'd say to you, don't. Why not? It's got 500 companies in it, and most of them are rubbish. It's just the law of averages. You want to own the good ones. There is an easy way of doing that, and that is to look for the S&P has a subsection which is called my screen's about to turn itself off, which is called the quality index. And what they have done is they've taken criteria quite similar to mine, and they select about 100 out of the 500. So you then only own the 100 rather than the other 400 rubbish companies. Now, there are a couple of ETFs you can look for. I've looked at one or two for you. One is called SPHQ. That's the ticker. Trying to find it on the screen here, but it doesn't. Here it is. SPHQ. I'm not promoting this. I don't get anything from Invesco. I'm sure there are other ETF providers that do something similar, but they basically track the S&P 500 quality index. And what's in it? Well, it's Microsoft, Nvidia, Google, MasterCard, Apple, Exxon, Adobe, and so on. Procter & Gamble, all, in my opinion, pretty good companies. That's one thing to do. Now, if you don't live in the US of A, you may not be able to buy SPHQ because it's, I think, only offered to Americans because they are special people. If you say are in Europe, well, there are other ETFs that track it. There is a similar setup, for example, from iShares that tracks the MSCI World Quality Index, and it's called IWQU. And that is a little bit more global. It includes some European stocks and so on. And what do they own? Let's have a look at it. Again, Microsoft, Nvidia, Apple, Visa, Meta, and so on. But then it also owns Novo Nordisk, that European fat loss drug, and a few other things, but fairly similar setup, maybe just a little bit broader because they're available, however, in European countries, for example, or Singapore and other places. So I would look at something like that. Now, how do you then buy this? Well, you need to understand the cycle. And by the cycle, I mean the market emojis, because what happens is that when people feel excitement in the stock market, they feel euphoric. That is when it's riskiest to buy. This is unfortunately when most retail investors like you and me buy because it feels good. Everything has gone up a lot. Your neighbor just made a lot of money on Tesla or on Nvidia or whatever it is. It's the flavor of the month. So they buy up there and then the market starts dropping and they get fearful and they panic and they get angry. And then down here they sell. And what have they done? They've taken money to Wall Street and they've donated it to non-deserving Wall Street traders so that they can buy themselves another yacht or maybe another house in the Hamptons for mistress number 3. So don't be that guy or that girl. Do it the other way around. Buy when everyone is freaking out and buy less when everyone's celebrating like a maniac. That's the simple logic. So how can you do this very, very simply? Well, you set aside a fixed amount of money. You say, I'm going to invest $1,000 per month on the first of the month. And if you do that, and you do that especially when the market is tanking, well, say at the moment that buys you 10 shares. At the current share price, well, when the stock market drops, what's going to happen? Well, it might then buy you 13 shares. So in effect, you're going to be buying more when the market's cheaper and less when the market's more expensive. But you need to have the discipline to do it. There are lots of services out there that offer you automations for this. They will automatically pull a certain amount out of your paycheck as it lands in your bank account and invest it. Take advantage of that. Just make sure they don't charge you any fees for that service because that's daylight robbery and we don't want that. Now, if you found this insightful, I'd love to give you for free an entire program, but I've tried it and nobody completes it because it was free. So what I do instead is rather than the $1,500 I normally charge for our flagship program, I'm going to charge you only $15. And that way you have a much higher likelihood of actually completing it because the human psychology is a really, really weird one. I'm a trader. I spend a lot of my time studying human psychology because that's what gets my students to success. This will teach you what we've just talked through here, but in a lot more detail. It'll turn you essentially into sort of a portfolio manager where you understand how the market really works, and it's $15. If you didn't like it, tell me, I'll give you your money back because I want you to be satisfied and happy. So go to felixfriends.org/stocks. And the coupon code will automatically be applied. You're not going to get charged $1,500. You're just going to get charged $15. I think that's a pretty good offer, and it'll still motivate you to complete this. And of course, also make sure you get your hands on the spreadsheet so you have the data so that you can actually make use of all the things you've just learned. This was a little bit too much. I apologize. I was trying to squeeze everything I know into very short period of time. You can, of course, replay this, and you can, of course, also send me messages. I shall read them and I shall reply you. My email address is also in the description of this video. I thank you for watching. I'd love you for subscribing to the channel, and let's make this year and the coming one the best one yet for you and your financials.